You have $500 and you want to make it work for you. Smart move. But now you're staring at your screen wondering whether to buy an ETF or just go all in on that one stock your cousin won't stop texting you about. Don't touch that stock yet. We need to talk first. Welcome to the comparison nobody told you about when you first started thinking about investing. Today we're breaking down ETFs versus individual stocks specifically for someone starting with $500. No jargon, no boring lectures, just honest talk about which path actually makes sense for your situation right now. Let's start with the basics, because if you don't know what these things actually are, none of this comparison matters. An ETF, or exchange-traded fund, is basically a basket of different investments bundled together into one thing you can buy. Think of it like ordering a combo meal. You get the burger, the fries, and the drink all at once. An individual stock, on the other hand, is ownership in one specific company. That's more like ordering just the burger and hoping it's everything you dreamed of. Now here's where things get interesting for someone with $500 specifically, because the amount of money you're starting with changes the entire conversation. Let's talk about risk first, because this is where most beginners make their biggest mistakes. When you put your $500 into a single stock, you are betting everything on one company performing well. If that company has a bad quarter, announces disappointing earnings, or just gets caught in some corporate scandal, your $500 could shrink really fast. We're talking potential losses that'll make your stomach drop. Individual stocks can be wildly volatile. One bad news day and your investment is down 20% before you've even had your morning coffee. ETFs behave very differently. Because they hold dozens or even hundreds of different companies inside them, one company having a terrible day doesn't destroy your whole investment. The gains and losses get spread out across all those holdings. Your $500 isn't riding on one horse. It's spread across the whole race. This is called diversification, and it is genuinely one of the most powerful concepts in investing for beginners. Here's a fun way to think about it. Imagine you're at a pizza party and someone only brought one pizza. If that pizza burns, everyone goes hungry. Now imagine 50 people each brought a pizza. If one burns, there are still 49 perfectly good options. ETFs are the 50 pizza party. Individual stocks are the one risky pizza situation. Now let's flip things around, because individual stocks do have some real advantages worth discussing. The upside potential is massive. If you had bought $500 worth of Apple stock back in the early days, you'd be having a very different conversation right now. Individual stocks give you the chance to multiply your money dramatically if you pick correctly. ETFs are designed to give you steady, reliable growth that tracks the broader market. That means you're unlikely to get those explosive gains, but you're also protecting yourself from explosive losses. For someone with $500 just starting out, that protection actually matters a lot more than most people realize. Losing half your starting investment doesn't just hurt your wallet. It hurts your confidence and your motivation to keep going. Protecting that foundation is genuinely important. Let's talk about time commitment, because this one surprises a lot of beginners. Managing individual stocks takes real effort. You need to research companies, understand their financials, follow industry news, know when earnings are being reported, and constantly evaluate whether your thesis for buying is still valid. This isn't something you can just set and forget. If you're not willing to put in that time, individual stocks will punish you for it eventually. ETFs are practically designed for people who have better things to do with their time. You buy an index ETF that tracks the broader market, and you let it do its thing. You don't need to monitor it daily. You don't need to read quarterly earnings reports. You check in occasionally, maybe add more money when you can, and just stay consistent over time. For a beginner who's still learning the ropes, this lower time requirement is actually a huge benefit because it lets you stay invested without constantly second-guessing yourself. Here's the psychological piece that almost nobody talks about. Individual stocks will make you emotional. When your stock drops, you'll panic. When it jumps, you'll get greedy and maybe take unnecessary risks. Our brains are genuinely terrible at staying rational when our money is moving around. ETFs, because they move more gradually and carry built-in diversification, tend to trigger fewer panic responses. You're more likely to stay invested and let time do its job. So where does this leave someone with exactly $500 standing at the starting line? Here's the honest answer. ETFs are almost certainly the smarter starting point for most beginners. You get instant diversification, lower risk, less time required to manage, and a smoother emotional experience while you're learning. You can buy into a broad market ETF covering hundreds of companies and immediately be more protected than someone who put all $500 into one company. That doesn't mean individual stocks are wrong forever. As you build your knowledge, grow your confidence, and increase your portfolio size, adding individual stocks alongside your ETF foundation becomes a really compelling strategy. Think of ETFs as your base and individual stocks as your eventual experiments once you know what you're doing. The goal right now isn't to get rich overnight. The goal is to build a habit of investing, protect the money you're starting with, and give yourself time to learn without blowing up your account in the process. Your $500 is more powerful than you think. It just needs a strategy that matches where you actually are right now, not where you hope to be after one lucky pick. Start smart, stay consistent, and let your money grow while you keep learning. And whatever you do, please put the phone down and stop texting your cousin back about that stock tip.